Hello, everyone. Dave Keller here, the Chief Market Strategist at StockCharts.com. Super excited for a special presentation today. We have a great guest, Jessica Inskip. She's the Director of Education and Product at OptionsPlay. We have been talking with the folks at OptionsPlay for a little while now, talking about how we can empower our users at StockCharts to make better investment decisions, not just using stocks and ETFs, but using the options market. We've had a lot of requests to improve our options functionality, to give people access to the options market and understand how they relate to our deep and powerful suite of technical analysis tools. Our friends at OptionsPlay are really helping us to be able to do so. So I'm excited to welcome Jessica Inskip to today's show. Jessica, how are you? It's good to see you again.
I'm doing great. Thank you so much, Dave. It's been a while. So happy to be here and to connect again with the wonderful Stock Charts team and bring the beauty of options to you.
Well, no, it's a pleasure to see you again, Jessica. I know you were on my show, The Final Bar, and we had a great discussion, and hopefully we'll do that again soon. But it's been a real pleasure talking with you and Tony and others at OptionsPlay. You guys are experts in equity derivatives and how investors can use those to protect their positions, to take additional positions. And we, considering ourselves expert in technical analysis, sort of a perfect marriage of two important disciplines that seem very complementary. So I'm excited. I know you're going to prepare. You have a presentation prepared about an underutilized income strategy in the options market. What is it, and how can we use it?
Absolutely. So you are absolutely right. Technical analysis and options traders tend to go hand in hand, and perhaps it's the data that's driven behind it and so many things that we can dive deeper into. However, options traders actually utilize the obligations inherent of those contracts to buy and sell securities. So almost like the way you define your entry and exit points via a limit order, you can utilize options in the same way, shape, or form. So the presentation I have with you, I'm actually just going to introduce that subject to our listeners and talk about stocks versus options. So I think it's really easy when we're first beginning our trading journeys and we think about stocks and buying and selling securities is that symmetrical risk profile. Whatever you spend is the most that you can lose, right? Whenever we invest in the stock market, we know that we're accepting volatility and we're utilizing that volatility to maximize our returns. We know that we're going on a roller coaster. There's going to be ups and downs. We're prepared for that. However, we add a layer of complexity, and maybe it's building on that analogy, a roller coaster that has a little more special effects or something like that when we add options, because we're adding an expiration date and also other pricing mechanisms. The influence of an options price or the premium is derived from the underlying security, but there are also two other components that are associated with that as well. Meaning a option is issued as a call or a put. Today, I'm going to talk about puts. Puts contain the right to sell an underlying security. And if you're selling the put, which is what we're focusing on today, and we'll expand on that more, you are obligated to fulfill the other side. You are obligated to buy the stock whenever the person who purchased that long option or an offsetting position at their discretion. The way I like to think about it is as if you were driving in a car. When you're selling options, you are the passenger. You're not the one that's making the decisions going left or right. However, we can pay attention to our surroundings and understand if the driver is going to stop, go left or right. And that's the mindset that I want to make sure that you have whenever you are trading short options. As you are the passenger, you're obligated to go left or right because you got into the car. So keeping that in mind, we should expand on the put side and that pricing component as well with options. So we know if it's issued as a put, it contains the right to sell. So if you've got an ABC stock that's at $100 per share, and we have a put that contains the right to sell at $150 per share, well, I could buy ABC at the market at $100 per share and utilize the terms of that contract and execute upon them and sell at $150. So it has to be worth at least $50. Now that's an extreme example, but that's the way that the pricing mechanics are derived from the security, hence the name derivative. But the two other components that are extremely important are time until expiration. Now, no matter how hard I try, we cannot go back in time, even though I would love to, which means time is always working against you, which is a decaying factor of an option. And that third component is implied volatility. Think about Fed announcements or earnings announcements. We anticipate a movement in either direction. Therefore, it makes the premiums more expensive. So when you're selling options, your goal is for it to not have that exercisable value. You actually want it to go down in value as much as possible. That's important to know because you're obligated to fulfill the other terms of that, the other side of that contract, if you will. So in the case of the put, I'm obligated to buy. Time decaying works in my favor because it makes the option go down in value. It's bullish because it's not worth as much or it's not worth anything if the market is a more favorable price, meaning I could sell on the market at a much more favorable price than the terms of the contract. So that's how it's bullish. We want it to go above our strike price, which is that agreed upon price. And if we see decaying implied volatility, that helps you understand your optimal environments. And I would love the listeners and viewers to keep that in their mind. There is definitely varying volatility right now. We are historically having low volatility, but other securities might have spiked implied volatility. And when things are expensive, that's when you want to sell. So just keep that in mind as we move on and discuss the cash secured put, which is what we're focusing on today. But that's my high level overview of how options work in a nutshell, very quickly, Dave.
I know you wanted to go through sort of a theoretical example. How does this actually look? Talk us through the cash covered put.
Yeah, so a cash secured put, it has the same risk potential as a stock. Remember, the most that we can lose is the amount that we spend. It is bullish because we want the security to go up in value. And again, that risk is just the obligation. So that same example, we've got a contract that represents the right to sell at $100 per share. We're obligated to buy at 100 per shares. That obligation becomes the risk. However, you sell the cash secured put, which means you collect an upfront premium. So we're going to think about that in the terms of yield. Sometimes when we're buying stocks, we're either a growth investor, maybe even value, but normally you fall under growth or income. Do you want capital appreciation or do you want income? And you prioritize one over the other. The way that we're utilizing options in this method is to buy stocks and maximize yield. So we're focusing on that yield aspect when we're utilizing cash secured puts and that obligation to buy stock. So in order to construct that strategy, you've got to make sure you have the cash available to buy the security. We sell a put and you utilize that cash as collateral. And when you put a limit order in with your brokerage firm, your cash is tied up. You can't really use that cash and put in another type of order. So think of it in that same type of terms. And what that does is it creates an obligation to sell the stock at that predefined strike price. So with that comparison of a limit order and utilizing Apple at an old price, so I do apologize for that. But let's say we've got Apple and you want to buy it at $160 per share and you have a price target, which is extremely important for a trader's perspective. We want to have price targets of $175 per share. Well, my risk for buying that on the limit order is spending $160 per share. And with the short put, I have that obligation of buying at $160 per share. But now I'm bringing in a premium of $3.15. So for that same obligation, I'm actually collecting a bit of a yield. Think of that in the terms of yield. But I'm collecting that for the duration of the contract. In this example, when the prices were pooled, it was 45 days until expiration. So for 45 days, I'm obligated to buy Apple at $160 per share. And in exchange for that obligation, I'm receiving $3.15. And what that does is it will maximize your reward with thinking that price target in mind, but it also reduces my risk exposure by the same amount because I am receiving $3.15. You can also think of it as a reduction of cost basis. If the stock, remember, this is a bullish strategy, so you're going to realize your maximum profit potential if Apple was above $160 per share by expiration. However, if Apple were to move down below $160 due to some calamitous event of some sort, you would then be obligated to buy at $160, but you received $3.15. So if you think about that in a snapshot of time, where Apple you're selling an at the money option, which means the strike price, the agreed upon price is the same as the market price. it actually has less risk exposure than buying the stock outright. And I love to use the comparison of a limit order for that reason. Let's talk about outcomes as well. I think that's important. So give you just for easy math, that changes strike price, or excuse me, the premium to $5. So we have the obligation to buy at 165, and we have received a premium of $5 per share. So what that means is, again, if Apple, the underlying security, closes above that strike price of 165, it expires worthless. We keep the $5 premium. That represents about a 3% yield based on that 30 or 45-day period when we sold that contract. And if it does move adversely or go down, then we are just assigned, we buy Apple at 160 effectively because we're obligated to buy at 165, but we receive $5 per share because one contract represents 100 shares altogether. So this is the way that options traders utilize cash secured puts to buy stock. There is a important component that I do want to make sure that people are aware of, because sometimes this just sounds oh so good to be true when you first listen to it. There is a risk that is very important. It's called upside potential, meaning we are receiving a $5 premium in this scenario. That's my max gain. When I buy a stock, your max gain, of course, is infinite. It can theoretically go to an infinite price. Meaning, if we use that same scenario where I'm buying at 165 when the market's at 165, if this were to move up past 170, then you would have made more money buying the Apple stock. So in all reality, it's actually a neutral to bullish short term, but long term, you're bullish and you want to participate in that capital appreciation. So think of it as upfront income to buy the stock, something that you can do continuously until you're assigned the security. Once you own the security, then you start participating in capital appreciation. And of course, I have one more slide that we like to put together. These are just the what and when, the setup and tips, and closing out, because again, there is a layer of complexity when you're dealing with options. So when we utilize cash secured puts to buy stocks, you have that neutral short-term view, long-term bullish view. You have the cash ready to go, and then you create that obligation. You don't participate in a rally beyond the premium that you received. However, you can think of it, the premium, you do receive it up front, and it's a reduction of your cost basis overall. Tax-wise, completely different story that we are not talking about today. The setup and tips, so these are just the expert tips that we've had a lot of back testing at OptionsPlay that I'd love to share with you. Optimal time frame due to theta decay, or time decay component that helps with short options, is about 30 to 45 days. And that's because the time decay that decays from the premium, it's not linear. It actually as the closer you get to expiration, it falls off of a cliff. And that happens about 14 to 21 days. So you just want to capitalize on that. We did the back testing for you and made it easy. So I'm just going to say 30 to 45 days. And then when choosing a option, we look for a 45 to 50 delta, which we're going to bring up the options chain and maybe talk about some practical application. And the IV percentile or over 50 just tells you if something's more expensive. And then we've, of course, got just some exit strategies in mind. If you have an exit strategy when you're trading for stocks, we want to apply the same for trading options as well. And our best practices are just having an exit strategy on your profit side as well as your loss side. And those best practices are displayed on the screen with some examples without going through all of those in so much detail.
Jessica, that was so well done. I really appreciate you talking through the construction of the short put strategy, how it relates to sort of a plain vanilla, long only, equity strategy. Interesting to see the relationship and what that premium that effect that it makes. But you sort of gave a nice options 101, just thinking about the different aspects, the time decay and the volatility and all of that. Can we talk about a practical application? Can we use the StockCharts platform? Let's look at an example here recently.
Absolutely. And I think and thank you for the kind words, Dave. A lot of times people who've never traded options before see them as terms of speculation, but they actually can be utilized for the long term and for means of income. So happy to share that with the StockCharts viewers. Now, utilizing StockCharts.com, we've actually worked with you to develop this wonderful options chain. And I'm bringing up some practical application, just utilizing Nike as an example. So the way that a options chain is laid out, we've got calls on the left and then puts on the right. So we're going to focus on the puts today, naturally, because we talked about the cash secured put. I've already pre-pulled up about 45 days until expiration, which is that sweet spot that we talked about. But when we talked about that practical application, I gave you the terms of delta. Now, without going too deep into how all of the Greeks work, delta, the definition means that as the underlying security moves by $1, all else equal, that's how how much the premium will move. Because remember, the premium's not derived just from the underlying security. There are other external factors that affect the price of the option. But because of that, delta is also used for the probability of being out of the money or in the money at expiration, depending on the way that you use that, which means we can utilize it to choose strike prices. And another way to think about delta, most commonly used Greek, is one is your destination. So that's the deeper that an option gets in the money, the higher the delta. It magnifies. And remember, when we are selling options, we do not want it to have value. So that's a good way to think about it in the terms of delta. Now, when I'm looking at an option chain, we've got it colored very beautifully for ease of use. Anything that's highlighted in green, it means that it's in the money. Anything that is not is out of the money. So when I'm looking at selling a cash secured put, I've got Nike here. I perhaps am wanting to buy Nike for whatever reason is from methodology, or even however you apply your same type of principle for buying securities. So perhaps you found a predefined screen on one of StockCharts advanced charting schools or charting tools, and perhaps whatever process that you utilize to pick your underlying securities, that's already happened. Now, instead of just putting in a limit order or buying stock at the market, we're going to select a cash secured put to buy that stock and utilize that obligation found within options. So when I'm pulling up the option chain, I've got the strike in the middle. That's the price that I'm going to be obligated to buy. And when I'm pulling delta again, I want to look at something close to 0.5 and around this area. So the 0.38, the 0.43, that would be a good option for me to consider, because remember, the goal is to buy the stock. Now, if you watched Tony's presentation where he talked about covered calls, another mechanism that is actually utilized once we own the security, we would see a different delta being chosen. And that's because we already own the stock and we're caring for capital appreciation. We don't own the stock right now, so we're prioritizing yield. So I want to make sure that we marry those presentations together, because that is essential to this process. But meaning, you would choose a strike price close to the current price. That should be representative of about a 0.5 to a 0.4 delta, which is this column right here. And then you can also see the implied volatility to see if perhaps it's a little more expensive than usual. You look at it relative to itself. If we were to pull a date with an earnings date, an expiration date with earnings, you'd see a super high implied volatility. So that's a good explanation and something I encourage our viewers just to explore. Then you would just simply put it in order on your platform, and it's as simple as that. So for this one, for example, I could expect to receive the midpoint which is 276. I would sell that, and I would be obligated by September 1st to buy 100 shares of Nike at $108 per share. And in exchange for that, I would be receiving $2.76 per share, so $276 total. And that's the way that you would practically apply what we just talked about. It's really that simple.
Jessica, this was awesome. I really appreciate you taking some time to show the new options change functionality. I know we're so excited at StockCharts to be able to provide some of this information. And I think with the expertise that you and Tony and others at OptionsPlay are bringing to the table, we're really giving our viewers and our StockCharts users some very powerful approaches and some powerful tools to be able to make sense of those. Thanks for joining me today, Jessica. It's great to see you again. And thanks for sharing all of this expertise with us.
Thank you so much for having me. It was a pleasure. I hope to see you soon, Dave.
Awesome. Thanks so much, Jessica. That's Jessica Inskip. Jessica's the Director of Education and Product at OptionsPlay. We're so excited about our partnership between StockCharts and OptionsPlay. Tony and Jessica and the team there really understand the options markets and how to apply those tools, and have a great practical set of tools to empower you to make better decisions and enhance your returns and protect your investments using the options market. We think it's a great complement to our toolkit in technical analysis here at StockCharts.com. We look forward to a lot of more really good things with our friends at OptionsPlay here very soon. Again, I'm Dave Keller at StockCharts.com. Thanks so much for watching. Expect a lot more great options-related content in the future on StockCharts TV.